Open Google Maps. Zoom into Western Europe. On the western edge of the continent, surrounded by the Atlantic Ocean, lies Ireland. To the east is the United Kingdom. To the west, nothing but open ocean stretching toward North America. It is the second largest island in Europe, but politically it is divided. About 5/6 form the Republic of Ireland. The northern part remains part of the United Kingdom. The Republic covers about 70,000 square kilometers, smaller than South Carolina. Population in 2025 is just over 5.3 million people. By 2025, its GDP per capita had risen to nearly $131,594, surpassing wealthy nations like Qatar, Norway, and Switzerland. So how did a country once defined by famine, emigration, and unemployment become one of the richest nations on Earth? The answer begins in the 1980s. In the 1980s, Ireland faced severe unemployment, high public debt, and mass emigration. Many economists described it as structurally weak and peripheral within Europe. Then, it made a strategic decision. It introduced a low corporate tax rate of 12.5% on trading income, one of the lowest in the developed world. At the same time, it invested heavily in education, particularly in science, engineering, and technology. It joined the European single market, giving companies access to over 400 million consumers. Ireland offered three things: low taxes, English-speaking workforce, full access to the European Union. That combination proved powerful. By the 1990s and early 2000s, American technology and pharmaceutical companies began setting up European headquarters in Ireland. Apple established major operations in Cork. Google built its European base in Dublin. Microsoft, Meta, Pfizer, Intel, and many others followed. By 2025, US multinationals account for a significant share of Irish corporate tax revenue and exports. It became a hub for intangible assets such as intellectual property, patents, algorithms, and software licensing. This is where the story becomes controversial. For years, multinational firms used structures known as the double Irish. These allowed companies to shift global profits through Irish-registered entities and reduce effective tax rates dramatically. In 2016, the European Commission ruled that Apple had received illegal state aid and ordered Ireland to recover 13 billion euros in unpaid taxes related to past arrangements. Ireland initially appealed the ruling, arguing it had followed its own tax laws correctly. The case became one of the largest corporate tax disputes in history. Economists call this base erosion and profit shifting, or BEPS. It refers to strategies that move profits to low-tax jurisdictions, regardless of where real economic activity occurs. Critics argued Ireland enabled profit shifting. Supporters argued it simply operated a competitive tax system within international rules. The double Irish structure was phased out by 2020 under EU and OECD pressure, and in 2024, it adopted the global minimum corporate tax rate of 15% for large multinationals under OECD reform agreements. So the model evolved, but the impact remains visible in the numbers. In 2015, Ireland's GDP grew by 26% in a single year, not because factories doubled overnight, but because multinational corporations relocated intellectual property assets into Ireland. Economist Paul Krugman famously called it leprechaun economics. Ireland's headline GDP figures are inflated by multinational accounting flows. That is why economists often look at GNI star, a modified measure that strips out some multinational distortions. Using GNI star, its income per capita is lower than headline GDP, but still among the highest in Europe. So the wealth is real, but the scale is sometimes exaggerated by accounting mechanics. Let us compare. Norway built wealth from oil and invested it into a $1.5 trillion sovereign wealth fund. Switzerland built wealth from manufacturing, pharmaceuticals, and banking. Singapore built wealth from logistics, finance, and disciplined state planning. Ireland built wealth by becoming the European gateway for American multinationals. Corporate tax receipts now form a large portion of Irish government revenue. In recent years, a small group of multinational firms accounted for a significant share of total corporate tax collected. That creates concentration risk. If global tax reforms tighten further, or if companies relocate intellectual property elsewhere, Irish public finances could feel pressure. But the spillover effects are undeniable. It has high wages, low unemployment, a thriving tech ecosystem, and strong public finances compared to the 1980s. Dublin is now one of Europe's most expensive cities. That reflects real demand and real incomes. Look again at the map. Ireland sits between North America and Europe. It operates in a time zone that overlaps with both. A US company can manage European operations from Dublin efficiently. That geographic and linguistic positioning reinforced the tax advantage. This country did not just offer low taxes, it offered integration into the EU legal system, strong property rights, and regulatory stability. That matters. Ireland's GDP per capita may exceed $140,000 in 2026, but part of that reflects global capital flows rather than purely domestic production. Some economists argue it optimized within global rules. Others argue it facilitated international tax minimization at the expense of other countries' tax bases. What is clear is this: Ireland transformed from one of Western Europe's poorest economies into one of its richest within one generation, not through oil, not through minerals, but through tax policy, education, and strategic positioning in the global economy. So here's the real question: is Ireland a clever small nation that mastered globalization? Or is it an example of how modern finance reshapes national statistics? Either way, this small Atlantic island quietly rewrote the economic playbook.